All right, folks, welcome back to Into the Cauldron. So earlier this year, I was just going over some financial data related to the Dow Jones, the S&P 500, and we've had the crazy increases in not just the stock market, but it was also the housing market with the prices. So I was curious. I wanted to see what the relationship between ownership of stocks, 401k, mutual funds, these types of things, and the home ownership rates. Have they increased in order to kind of support this narrative? Not narrative, but this. The drastic price increases we've seen in both of those markets. So that kind of led me to write some notes down, and I'm going to present to you today some of the information that I found, some of the data. And so what I'm going to do is kind of create a new series here, and forgive me, I'm going to be, there's a lot of data. I've got the main points on the board here, but I've got a significant amount of things here, and it's kind of in small print, so I'll be referencing back and forth. But what I'm going to do here is I'm going to start kind of a little bit of a series, and it's going to be a series related to kind of economics and social behavior. So the objective here is going to be to kind of contrast, merge social behaviors with markets. For example, when housing and stock prices increase, that should signify higher ownership rates. Higher ownership rates would thus create a sort of shortage or the necessity for more houses. We're going to be looking for trends, patterns, abnormalities, these types of things. And so today, what we're going to do is we're going to look at the stock market indices versus the rate of stock ownership. And the data that I collected goes back to basically the dot-com bubble. So getting close to 20 years now, but year 2000. So the market, since the financial crisis is up, so one would expect to see an increase in the ownership of stocks, right? So the first thing I want to mention is that this is the first video I'm going to do, but where I've got a lot of different links, and I'm going to put them down below. So the data that I'm referencing here, the data I'm referencing on the board is going to include links with more detailed information, and those will be posted below. Okay, so let's get going here. So first, just some of the links that I used to collect this data were a study from 2017 that Gallup did that with regard to stock ownership. They've traced the rates of stock ownership relative to the span of the timeline we're using today. I used the Federal Reserve's own website to kind of track the Dow Jones. And there's another website that I like just because it gives longer periods of data, and that is Trading Economics. Okay? So what we have here is, a collection of data, obviously, but what I did is I used the Dow Jones Industrial Average, the points, and these right here, these dates, January 14th of 2000, October 9th of 2007, and October 3rd of this year. These are our peaks. These are the peak during the previous and current economic cycle. This is when the market peaked in terms of Dow Jones being at the highest point totals. Okay? And so what we're going to do is we're going to kind of track things based on that information. Okay? So, first thing that I wanted to get into was the Dow Jones point totals themselves. Okay, so they're not written here, but in January 14th of 2000, the Dow Jones hit its peak before the dot-com bubble collapsed. The point total was 11,722. We'll just call it 11,723. Okay? On to the next peak before the financial crisis. And the point total at this time was 14,165, roughly. And again, the data, where I'm getting this information will be linked below. And then finally, just a couple weeks ago, on the 3rd of October of this year, 2018, the record high, the all-time record high was reached, and it was 26,828 points, which is pretty significant. Okay, so first thing we're going to look at here is, since we have such, massive increases in the point totals, and actually looking at it now, I probably should have put this right here, the Dow increase in terms of percentages first, but you live and you learn. So anyway, we will start here at this kind of second point. So between January of 2000 and the next peak in October of 2007, there was a 21% increase in the point total for the Dow. 21%, okay? And so what I also did is, on Gallup's website, they give there's two kind of data bits here. The first one, I just took the percent of people as close to these dates as possible to gauge what percent of people or households own stock close to these peaks, okay? And so in 2000, 61% of people reported that they owned, according to Gallup, reported that they owned stock, okay? And so from that point to here, we had an increase from peak to peak of 21%. And the narrative, at least, that's painted here is seemingly, it fits, right? It fits relative, without getting into any external data. It kind of fits, right? More people, 65% in 2007, own stock than they did in 2000 at 61%. So we had a 21% increase in from the Dow. So the Dow went up, and so did stock ownership. However, it gets a little curious here. From the peak in 2007, with that 65% ownership of stock, we see that it's slipped significantly to 55%. So a huge decrease. But here's the strange thing. The point total, this, which is a gauge of the overall stock market, the Dow Jones, increased by 89%. So this is 4 times more of an increase than what happened previously during the previous bull market, and yet ownership plummeted. So this is very strange, right? And what Gallup also did, the data that it gave us, is it kind of gave us the averages. So relatively speaking, it was more 2001 to 2008, and then 2008 to the present was kind of 2008 to 2017. Sorry, I got lost a little bit here. What they did is they tracked what was the average ownership rate. Like, they took all the years that were included during each bull run, and then they just, took the total and divided it by the number of years, and they got their averages. Okay, so the average rate of ownership during this bull market was 62%. However, during the current bull market, that is significantly down to 54%. 54%. Okay, and so let's see, let me double check my notes here. Okay, good, we're covering everything here. So one of the things that I found really interesting is, well, first, what's the explanation for this? One of the things that was really interesting is from the current bull market, I actually forgot a data point here, now that I think about it. Let me see, peak to peak. Sorry about that while I pause here. Never mind. Anyway, the current bull market from the, this last peak to peak. Oh, okay, no, we did cover it. The point total. Sorry, forgive me, I got lost. I got a lot of notes here. So anyway, let's moving down. We need an explanation for this, right? How is it that we have this enormous increase in the stock market and yet we have plummeting stock ownership rates? Well, like in previous videos, we talked about the money supply. One of the things I noticed was that the money supply increased by 93%, which was significantly more than what the money supply increased by during the previous bull market. And so what I think is basically happening is the Federal Reserve, by pushing rates down to basically entice large institutions to borrow, they are taking those borrowings and they are basically plunging it into the stock market. It's the only explanation that could basically make up this huge discrepancy. And so let's see, going to my reasons here. So the large institutions were basically able to borrow money, I'll get right here. They're able to borrow money at very low rates, very cheap rates, and they're able to, being the first recipients of that credit, they're able to push it into the financial markets. And one of the things that people need to understand is that when you look at like CEOs and people that are really high up in different organizations, their compensation package is heavily weighted with stock, and so they have an incentive to boost stock market prices. Not only that, they have to answer to the board of directors who own immense amounts of stock in whatever company it is we're talking about, and the shareholders. So that they have multiple incentives to boost stock prices. So, it's not out of the realm of possibility, and more in later videos we'll actually go into this, but for them to basically borrow money and plunge it into the stock market. Furthermore, government pensions, chronically underfunded, heavily underfunded. And to my understanding, the pensions themselves actually are heavily weighted with, financial not instruments, but financial products, if you will, like stock, mutual funds, these types of things. So when the government borrows, which we know they did, because they run huge deficits every year, and they sell treasuries to the Federal Reserve, and those treasuries are monetized, like we learned in a previous video, and they go to pay down all of these debts that they have. And so the pensions, again, it's incentivized to plunge money into the stock market to make sure that those pensions are producing, in other words, or at least in an attempt to meet the shortfalls or meet the obligations. There's a better word. Let's see, lastly, so it's my opinion that the rate suppression and the excessive credit that has basically been created in the last almost 10 years now has created another gigantic bubble, which will eventually pop when rates rise to a point where people will no longer want to borrow, and so at that point the bubble will pop. But let's see, any other data points? No, that was it. Sorry. So yeah, anyway, in summation, I just wanted to kind of go through and compare and contrast the stock market and the the rising stock market and the ownership of stocks. And as you see, there is a huge discrepancy. And again, when you look at the increase in the money supply, huge increase, almost a doubling over the span of time of this current bull market, it's not hard to come to the conclusion that the current bull market's 283% increase has a lot to do with this number right here. So thanks for watching, and we'll definitely have more videos on related topics as time progresses.